This is a case study of Peachtree Securities presented by Richard Arias. A little bit of background on Peachtree. Jake Taylor is the founder and president, and he was experiencing decreased sales at a certain point in time. So he decided to offer trust and portfolio management services. This portfolio consisted of stocks and bonds, particularly electric utilities. This portfolio service took off, and it allowed Jake to hire his first in-house analyst, Laura Donahue. Her first task at Peachtree was to hold a seminar explaining to customers how differing securities affect portfolio performance. She was also asked to assess risk and find the required rate of return of an electric utility of her choice. Estimated total returns. Laura made a table with pertinent information regarding TECO, which was the electric utility company of her choice. When you look at the average state of economy, there's a probability of 40%. And when you look at the S&P 500 fund, it has the best return of 15%, which would lead you to believe that this is the best investment. T-bonds. T-bonds are largely risk-free, which means that you will be paid back. The government would do what they had to ensure payment. But in reality, a T-bond is not risk-free. For example, the one-year bond carries inflation risk and maturity risk. The inflation risk occurs when the rate of inflation is higher than your interest rate. And maturity risk happens when your dollars are tied up till maturity and interest rates are rising, so you miss out on extra income. Expected returns. Expected returns are the mean return of all economic states previously shown. In the table below, you can see that the S&P 500 fund here is also the highest rate of return, which would furthermore lead you to believe that the S&P 500 fund is the best investment. But further analysis is needed. Standard deviation and coefficient of variation. Standard deviation is a measure of total risk under the bell curve or a normal distribution. Coefficient of variation measures the dollar amount of risk per dollar of return. When we look at the table shown, we can see that TECO has a CV of 86.81. This means that you only risk about 86 cents per dollar of return if you invest in TECO, which is very good. If we had a portfolio consisting of $10,000 invested in TECO and $10,000 invested in Gold Hill, this is what the table shows. The expected portfolio return is 11.15%. The portfolio standard deviation is 7.55%, and the CV is 67.71%. A CV of 87 cents for Tico and $1.03 of Gold Hill is what the individual assets come in at. So this portfolio is much less riskier. This risk is lowered by diversification. This portfolio is weighted 50-50. If we were to change the weights, say 75% Tico, 25% Gold Hill, or 25% Tico and 75% Gold Hill, this would raise or lower the CV due to diversifiable risk that is inherent to each stock's returns. A similar portfolio, but instead of Gold Hill we have the S&P 500 fund. This CV is much higher than the previous portfolio at 106.37%. This shows that the S&P 500 is not a good asset to have with Tico. It adds market risk. Adding random stocks. If we have one stock and we randomly add to it, as long as the assets that are added have returns that behave differently than our original stock, then risk goes down. A portfolio should contain between 15 and 20 stocks to be fully diversified. Diversification lowers unique risk, but the portfolio and stocks themselves will still have systematic risk. Total risk is measured by standard deviation. Total risk contains diversifiable and non-diversifiable risk. Market risk is inherent in the market. Diversifiable risk is unique to an asset. Furthermore, the stock market will only compensate for market risk. Lines of best fit. This graph shows 3 lines. These lines are called the slope of best fit line, and they describe the relationship between the return on a security and the return on the stock market. These lines are also known as beta. Beta is a measure of systematic risk. We can see here in the formula for Tico's slope equals 0.7. So beta is 0.7, whereas the market is 1. The security market line. CAPM was used to find the required rate of return. When this is plotted on the graph below, it is referred to as the security market line. Furthermore, the expected return of 13.5% for Tico is also graphed. You can see that the expected return is above the required rate of return of 12.2%. This indicates that Tico is a great investment. Concerns about the required rate of return. If inflation rises, the required rate of return will go up as well. If the market risk premium rises, so does the required rate of return. If beta rises, the required rate of return will go up as well. Efficient market hypothesis. This is a theory that states that the market price of an asset reflects all available information. The assertion here is that the market cannot be beat because all pertinent information is known to all investors. If Peachtree believes in this theory, they could use all available information to make informed investing decisions. The effects of long-term debt. A decreasing long-term debt ratio will have a few effects. If debt goes down, obviously the cost of debt goes down. If there is a decreasing cost of debt, this leads to a lower cost of equity. The lower cost of equity leads to a lower required rate of return. And this in turn leads to a lower beta. Simply put, the less you owe, the less risky you are. In conclusion, when picking a single asset or a portfolio of two assets, the coefficient of variation is the best way to measure risk. When picking a portfolio of assets, the returns that behave differently will ultimately lower unsystematic risk. Beta is a good indication of market risk and should be looked at when choosing assets. The security market line is a visual indication of required rate of return. If the expected return is above the required rate of return, this is a good investment. Thank you for listening. Goodbye.